The Federal Reserve is expected to raise interest rates during their upcoming meetings March 15th and 16th. They are way behind the inflation curve, and any aggressive action is likely to cause a huge ripple effect in the economy. Now, how much will interest rates increase? What impact will this have on mortgage interest rates? Plus, how will this impact you financially as we move forward in 2022? And look, if you have student loans, credit card debt, or are looking to make a home or an automobile purchase in the near future, stick around because this video is just for you. And we're getting started right now. Hello and welcome to Ask the Lender. This is your go-to channel for tips on improving credit scores, eliminating debt, housing and mortgage advice, plus little-known strategies to building wealth and paying less money in taxes, because we all want to do that, especially in retirement. So help me and my channel out by subscribing and clicking that bell right there to get notified, and also liking and commenting below. Know someone who could benefit from this information? Look, do them a favor and share it with them as well. On Monday, Federal Reserve Governor Michelle Bowman said that she will assess incoming economic data over the next 3 weeks while deciding whether a 0.5 percentage point interest rate rise at the central bank's next meeting in March is needed. The last time the Fed raised rates by that much was way back in May of 2020 at the beginning of the pandemic. If you have credit cards or variable rate student loans, this will take more of your hard-earned money at an already difficult time financially. Look, we're all paying more money in groceries and gases, and living is getting more expensive. To make matters even worse, most experts in large financial institutions like Wells Fargo and Bank of America, they predict as many as 7 rate hikes this year, with another coming no later than July. And it's quite possible that will happen even sooner, considering the inflation train is not slowing down. And stick around a little bit longer as I share just how much this upcoming rate hike is going to cost you in your pockets. Also, if you have credit card debt and own a home with equity, we need to talk. You should be taking advantage of still historically low interest rates to pay off all of your credit card debt. The best time to act is right now before you see your credit card bills increasing at a rapid pace. Interest rates on most financial products, including your credit cards, is dependent upon the prime rate. And currently, the prime rate is 3.25%. Prime rate is affected by the Fed funds rate, which is what will be increasing upcoming in March. What can you do to protect yourself? If you have money in the bank, you can simply pay off your debt. If you own a home with equity, let's discuss doing a cash out refinance to eliminate that debt, lock in a lower fixed rate, and prepare you and your family for a bumpy road ahead. There is a storm brewing, and I'm here to give you an advance notice. See, all data shows that we are at or very near the peak of the housing market. The average sale price increased by $93,300 over the last 2 years, and that's by far the biggest increase ever recorded in a 24-month period. Let's compare the run-up to 2008 and what is actually going on today. The bubble that developed from 2002 to 2007 peaked at around a 47% price increase before plummeting by 20% from 2007 to the first quarter of 2009. If we see a similar pattern emerge for the bubble that has been developing since roughly 2012-ish, then we could see housing prices drop by maybe 30 to 40% over a 2-year period. And whatever the final numbers end up being, the evidence is clear. Based on data reported over the past 6 decades, America appears to be on the verge of a real estate crash. What will cause this bubble to burst? Well, to begin with, the Fed raising the rates when most Americans are already priced out of the market due to inflated home prices, that's the pin that's going to pop the bubble. This rate increase will potentially hit you in your wallet with higher credit card bills while stripping away the equity you have gained these last 2 years. Now look, I'm not a fortune teller or a financial planner. I'm just a regular hardworking dad who has experienced the 2008 crash, and I want to give you a heads up. If you have the ability to take cash out, pay off debt, and maybe invest some of your equity into a safe vehicle that is protected from market losses, you should consider doing that now while you can. But more on this topic in an upcoming future video. Consider that the housing bubble that popped in 2008 also led to the stock market crash, which wiped out the savings of multiple thousands of hardworking Americans. Maybe you remember that. See, my father, he was one of them. He was at retirement age in 2008 and had to work an additional 4 years. Now, while that doesn't sound too bad, 6 months into retirement, he was diagnosed with stage 4 pancreatic cancer and he passed away a few months later. So my advice to you is to live your life while you can. If you do not have the funds to pay off your debt and do not have a home with equity, how is this going to impact you? As mentioned earlier, one of the most significant rates influenced by the Fed funds rate is the prime rate. That's the prevailing interest rate banks charge their best customers. The prime rate affects many consumer product interest rates, including deposits, bank loans, credit cards, and adjustable rate mortgages. Fed rate hikes tend to be passed along to you and I, the credit card holders, within a month or two. And the average credit card rate currently is 16.13%, according to data from creditcards.com. Credit card rates vary based on your credit history, with those with lower credit scores paying an even higher interest rate on their credit cards. If the Fed, as predicted, increases the Fed funds rate by 2% over the next year, you can expect your credit card interest rate to follow, meaning that that average of 16.13% will now be 18.13. Now, look, if you have less than perfect credit and maybe have an interest rate of, let's say, around 24.99%, then look, you're going to expect an almost 27% interest rate. Bottom line, get out of credit card debt. Pick up a side hustle if you have to. Just don't be caught paying higher payments when the cost of everything is going up at a record pace. If you have found this information helpful, don't forget to subscribe, click that bell right there to get notified, and also share your thoughts below. See you next time on Ask the Lender.